Hi, this is Wiley Long with HSA for America. Today we are talking about the stock market and the changes that are going on and how it's affecting people's retirement plans. Joining me today is Kevin Conroy. Kevin is a longtime financial planner. He spent 35 years helping people plan their retirements and helping people deal with changes like this in the marketplace, although we've never seen anything quite this severe. So, Kevin, thanks for joining today.
Thank you.
Kevin, let's just dive right into it. There's, well, why don't you just summarize what's going on in the marketplace and how it's affecting people first?
Well, we can kind of get an idea that there's a lot of nervousness out there, and the guys that are managing money are also trying to predict the future, and the future is so uncertain they really can't get an idea of what this downturn is going to look like relative to stock prices and so on. But we can use some of the things that came out of Goldman Sachs, which, for a lot of people, you're probably seeing a loss of at least 20% in your accounts. And Goldman Sachs projects a 24% drop in GDP, which is 2.5 times what we saw in 1958. And I was born in 1957, so that tells you how long ago this was. And economic output, according to their numbers, should shrink for every month we go past this month, 10% per month.
Okay, so, well, nobody knows. Things could get...
Nobody knows, and this is uncharted territory. The Federal Reserve basically is backstopping the entire market right now. Foreign governments are dumping their treasuries, so our Federal Reserve has to buy those treasuries, which means that they have to open up, these back channels to make those markets liquid and provide credit.
So for individual investors who are nearing retirement age, or maybe they're 10 years off, or maybe they're recently retired, 20% drop or more could be quite impactful. How long would it take somebody to make up that kind of loss?
I always used to use the rule of 72. Normally what that means is whatever your anticipated rate of return is, you would divide that into 72, and it would tell you how long it would take money to double. But in this particular case, I'm using an example of if your portfolio dropped by 30%, in order to get back just to even at a 5% return, and again, I know that's probably a little too conservative, but it would take you over 7 years.
Okay, that's a long time. So, are there strategies that people can use to protect themselves against this kind of loss or further loss in the next few months?
Well, we kind of all know about savings accounts and CDs, but based on those rates of return, you aren't going to get the results you're looking for. There are products that are available, such as annuities. And annuities, there's a lot of reasons why people may or may not find an annuity that fits them, but it should fit into anybody that's concerned about guarantees as far as their income and as far as their life expectancy. And a lot of these annuities have gotten fairly sophisticated to where you could tie an annuity return to an index. You may not get the full return of an index, to where you could get a higher return than the 1 or 2% you're getting at the bank, and also have principal guarantee. In addition to that, we already know what your mortality is based on your age, and it could all be based on your health, but in general, we know how long you're going to live, and so the actuaries at the insurance company level can design a product that no matter how long you live, you're going to get an income from this.
Okay. So So an annuity can be a way where somebody can get a higher interest rate than they would in a CD or some safe investment, but they can also protect their downside.
Right. In other words, an insurance company is stating in a contract that they are going to guarantee that during a market downturn that you are not going to suffer a principal loss.
Okay.
But in an upturn, if the upturn's 20%, they're not going to offer you a 20% return, but you might get anywhere from a 5 to 8% potential return.
Okay. So this sounds like, a lot of people nearing or in retirement age, one of their biggest concerns is running out of money. And they probably have an idea of how much they can spend each year to last them. But of course, something like what's going on now can totally wreck those plans. So how can an annuity work in a retirement plan for somebody?
Well, we know if you have Social Security, we have to assume that'll be there every month. If you have a pension, we'll assume that'll be there every month. If you're withdrawing from, say, a 401k, when you have this kind of volatility, we
looks like we're having some technical issues.
This or a month-to-month basis, you may want to put into or at least explore what the options are with an annuity.
All right, you kind of froze up for me for a moment there, and I don't think we got to hear your answer.
Okay. Bottom line is there are specific strategies to protect you from the downside. The first thing that you would think about is that you have your Social Security or pension, and we have to make an assumption that that would still be coming in every month. Mm-hmm. So what we call that is mailbox income. It used to be that way. Now it's in your bank income on electronic transfer. If you know that your income is insufficient to meet your month-to-month goals, how do you offset that? And normally you offset that by structuring another level of income, say from an annuity or from your 401k, that would allow you to have the comfort of knowing that your bills are going to be paid month to month. And we could do that. We could design strategies within annuities. Not to say each strategy is designed for everybody, but we could tailor it to each person's specific needs.
Okay. All right. And some of these annuities you can actually structure where they will guarantee income for as long as somebody lives.
Right. When I first got into this business 35 years ago, I had no idea people would outlive their mortality tables. And I had people that were in their 70s that would live to 95 and even 100. And they live way beyond their life expectancy. And their life expectancy at 65 would be 82 years old, as an example. So they are definitely getting more than their share of what went into that annuity. And the other thing is we can guarantee at least what someone puts into that will be, if you predecease those mortality tables, we'll guarantee your heirs will receive what's left of those payments.
Okay. So they can invest money in this annuity. It comes with a guarantee, or if this is what they enroll in, a guarantee that it will pay them an income for as long as they live. But if they were to die shortly after that, they could still get some of that money back. Is that right?
Yes, there'd be a minimum guarantee of principal back.
Okay. What about the people out there that are looking at the market going, I've already lost it. The market's down. I don't know if I should do anything now because I'll just be locking in losses if I pull out at this point. What would you say to somebody like that?
Well, there's a natural tendency not to take losses. Everyone does that. I'll wait till it comes back. But what if we go into a deep, deep recession and you're waiting for that to come back? How do you, at least from a peace of mind standpoint, take some of those, even though those assets are in mutual funds or whatever they're in, take a portion of those and take those off the table as far as risk is concerned? Assets in the market as long as you're not going to need them. But if you have a shorter time horizon, you're probably wanting to move into a safer, a safer position where there's going to be more guarantees.
Okay. All right. Well, a lot of our clients have been reaching out to us and asking for help and advice on what to do. And I understand you've opened more time slots available on your calendar just to try to help people out, and you're offering just introductory 20-minute conversations just to see if a more deeper discussion is warranted. Give us an idea of kind of how that conversation works and what happens if you do decide to get into a deeper conversation.
Well, if we get into a conversation, it's just a matter of getting an idea of what your concerns are, what assets you have, what income you need, and what else is going on in your financial picture. It's not to dig into too many personal things, but the more information that, say, I would know, the more I can tailor my response and also tailor a solution that would fit your situation.
Okay. And your objective is to help people set up a plan that they can sleep at night without worrying about what's going to happen tomorrow with the stock market or what's going to happen in 10 or 15 years when I've been drawing money out of my savings for many, many years.
Exactly. This is a way to give you some peace of mind. I know that there's a lot of anxiety going on. There's a lot of uncertainty as far as what the outcome of this would be. And, you know, when you really start seeing these headlines that say in the deepest recession possible is coming, and none of us have ever seen this before, I would definitely do an accounting of whether or not you want to call me up or set an appointment or who you're working with. I would definitely try to get an idea of how this long-term downturn could impact you and your income. Because ultimately we're going to have high inflation, you would think, when they're printing money the way they're printing money right now.
Right.
So.
Okay. All right. So if you are already a client of HSA for America, then contact your personal benefits manager if you'd like to have a conversation with Kevin, and they can arrange that. There's no charge for this. We're just trying to help people out here. If you're not already a client, just give us a call. That number is 1-800-913-0172, and we will get you hooked up. So everybody out there, stay safe. Kevin, thanks for joining us today.
Thanks for your time.
And we will we'll reconvene again soon.
Okay, take care.
All righty, thank you.